The general expectation was that after the last votes were polled in this 5-state election, petrol and diesel prices would start rising again. Remember, petrol and diesel prices at the retail level are supposed to be linked to international rates and have been increasing consistently over the last couple of years. But there was no big change, and actually no change at all, since early November. And this was put down to the fact that 5 crucial states are going in for elections, and this would not be a good look on the government in power, even though technically the government has had nothing to do or is supposed to have nothing to do with the decisions that oil marketing companies make on the prices of petrol and diesel. Now, having given you that context, the question is, when will that penny drop? So everyone thought once the elections are done, the votes are counted, then the increases will start. Maybe that will happen after results are put out tomorrow. But the question still remains, how much of that burden are you going to pass on? Now, the Indian crude basket right now is priced according to what we were paying when crude was about $80 a barrel. That's the equivalent, give or take, of how much you're paying at the petrol pump, with, of course, government taxes, VAT, excise, etc. It's right now at 121. And though that impact will come in with a lag, the fact is that the government, oil marketing companies are buying crude at a much higher price than what they're charging for petrol and diesel from the average consumer. Who's going to make up that gap? Can you put all of that burden on the consumer when inflation of every kind is already peaking? The prices of everything is going up. That's going to be a difficult one. If not, then what are the options? There was, in fact, a crucial meeting to mull all of these options today. My colleague Prakash has this special report.
See, we are getting from our sources that the OMC losses on petrol, diesel have touched to rupees 15 per litre. So they are in huge pressure and have made a very strong case to Petroleum Ministry to allow them to revise petrol diesel prices on daily basis. However, petrol diesel prices are deregulated, but the OMCs have not revised the prices for more than 3 months. We are also given to understand that the Petroleum Ministry is collecting data to understand the impact of, excise duty cut that was done in November last year, and also evaluating the data to understand the possible, revenue outgo if there is a case to cut in excise duty again in coming days. Oil Ministry is in favor of providing relief to the oil marketing companies by allowing them to revise petrol diesel prices on daily basis. However, it has also requested Finmin to cut in, excise duty to provide relief to the consumer once daily price revision resumed by oil marketing companies. They have also requested to adopt a 3-pronged strategy, including the cut in VAT by state government. However, the Finance Ministry and Petroleum Ministry is in regular discussion. They are looking for a lot of options, but the final decision will be taken by the highest level in the government.
All right, Saurabh Chandra, former Secretary at the Petroleum Ministry, is joining us on the show. Amit Bhandari, Senior Fellow at Gateway House, who tracks energy investment and connectivity, is with us on the show. And I'm also speaking with energy expert Narendra Taneja. Welcome to all of you, and thank you so much for speaking with us, joining us on this discussion this evening on the India development debate. Mr. Chandra, first to you. Now, what really are the options the government has? It's not as easy as saying, okay, let's part with all of the excise duty that we collect, because the fisc is not in the pink of health either. So what would be the kind of breakup that the government could look at right now to ease the burden or at least soften the blow on the average Indian consumer of these high crude prices?
See, as the opening batsman, I have to face bouncers. And you bounced one at me. Now, it is a tough choice. and as I take it, it is probably going to be split at least 3 ways. The consumer will have to bear a part of the burden. The government could look at cutting excise and VAT. It's a very difficult choice because it's a question of bearing the pain in the present by not cutting it, or taking additional debt and postponing this pain to the future. As it is, the interest payout in the budget is very high. And the third is that the OMCs take some of this cut from their margins against inventory gains, and the formula by which they determine prices itself has some cushion. Now, another thing that I'd like to go back in history, and that is when the under-recovery regime was there, then the upstream public sector companies were giving crude oil to the public sector OMCs at a discount. Now, whether that would come in a deregulated regime, I do not know. But since these upstream companies are going to make windfall profits, maybe the government can look at having a windfall tax on such profits.
That would be looked at as a very regressive move. You talked about bouncers, Mr. Chandra. Imagine what those in the government are right now facing in terms of very tight options. One can only imagine. Mr. Taneja, is that now the only option which needs to be looked at? If upstream companies are going to make windfall gains, then maybe they should share some of that profit and ease the burden. But wouldn't that fly in the face of all of the reforms which have been made in this sector?
Well, as a matter of principle, I think I'll be against it. And don't forget, even for instance, if you go for that kind of approach, I mean, domestic production is only in the region about 14%. So still, when you look at the overall, budget, 85 to 80%, we are still importing. Rupee is going down, crude prices are going up, uncertainty is very high, insurance costs have gone up. So all across US is kind of mayhem, and the world is basically entering, including India. We are entering a kind of an economic war. I mean, if you want to use the other term is different, but basically we are entering into that. It's an economic cold war with energy at the center of it. So that's the world situation, and oil is a global commodity. Even more so for us, since we import, we are so heavily dependent on imports. So I think, therefore, we need to look at our budget, our economy, even our individual company, where the government-owned, the private-owned tax regime is all that, and prepare for a very tough ride ahead. Because the next few years are going to be very tough for economies like ours. Because as I said, that this economic cold war and the United States, Western country, they are basically preparing for a long haul. Russia, at the same time, beyond a point, would not be able to fight back because their dependence on oil is so high. But nevertheless, we are going to see this tremendous turbulence in terms of the oil world. And since we are one of the largest importers, and we are the third largest oil market in the world, and also consumers. So it's going to be tough for us. Therefore, as government or as corporates or as state governments, we need to be preparing for that. So my own sense is that, we should start taking, decontrolled petrol, decontrolled diesel, all these things very seriously. When prices go up, pass on the burden. When the prices go down, then pass on the benefit of that to the ordinary consumer. And in the process, educate your consumer. What happened in UP in the election? One political party has offered free petrol, free diesel. I mean, we got to stop it. And at the same time, we need to give our, refining companies, marketing companies more autonomy. And the same goes for upstream. It's
tonight, Mr. Taneja, because I'm speaking to you purely as an energy expert. Are we talking about elections tonight and the politics of oil? Because I'm speaking to you as an energy expert today.
No, Tamanna. I'm speaking only as energy expert. But I'm saying, but oil is a political commodity. Whenever you discuss oil, whether nationally or globally, I mean, you can't completely ignore politics. Like in India also, for instance, as I said, that look at the price at the petrol pump and look at the buying cost, refining cost, etc. for our companies. Majority of the government owned. Now we look at the gap. Gap is in the region of about 16 rupees to 20 rupees per liter. Now the thing on this burden, you can't blame the ordinary consumer because you didn't increase the price the last 60 days. So basically, but you have to pass on. Beyond a point, these companies, their valuation will go to the Pacific if you don't do something about it. in the process, their buying capacity, trading capacity, refining, everything gets affected. We are supposed to make these companies world class.
Yeah.
So therefore, last line, Tamanna. So therefore, I think, we have no alternative as a country. The center will have to do something about excise. My sense is they will have to cut excise. State governments will be requested to cut their taxes, and at the same time pass on part of the burden to the ordinary consumer.
But so there is also a problem there, because you are going to weaken your fiscal position by cutting excise. It's in a year where your disinvestment targets are also looking woefully difficult to match. So many things. The LIC IPO was supposed to come by March. Now we don't know if that is happening. So it's a tougher choice that it seems. That the government bears the burden completely. If you ask upstream companies to bear the burden, again, one wonders whether anyone wants to ever invest in government companies if they're called upon to clean up a mess when it occurs. So really difficult choice. Amit Bhandari, I want to come to you with one more option which is being discussed. So America doesn't want to buy Russian oil. Europe is saying it's going to phase out Russian oil. Can India look at the option of buying more Russian oil cheaply? What is the proportion of Russian oil that we consume? Give us some context here.
Tamanna, I think right now we'd have, if I look at the physical volume of oil that comes to India from Russia, that will be very small. But what we need to remember is oil is a fungible commodity. So ONGC, for example, has ownership in certain oil fields in Russia. You don't really need to bring the oil physically to India. The financial returns you make from there can be used to pay for oil from elsewhere. So as of now, if there are chances to get some Russian oil cheaply, yes, we should definitely take them. But it will have to be a commercial decision by the companies. Given the sanctions, I think right now a lot of oil buyers are being extra cautious and avoiding any dealings with the Russian counterparty. That is my understanding. And that is also really the way sanctions work. They just put a fear inside of you that, okay, I may do a transaction which looks legit today, but I may have violated something later unknowingly, and I can be faced with very large fines by American regulators for that reason. And faced with that, faced with loss of access to the US financial system, most companies simply will not be willing to take that risk. We did see that play out in case of sanctions on Venezuela and sanctions on Iran as well. Significant volumes used to be imported from both of these countries. But following tighter sanctions, I think volumes dropped to practically zero from both of these. So I would say an oil company will be very reluctant to take on this kind of a risk right now.
So what are the options then, Amit? What are the options that we could look at? Because the world is now looking at alternatives to Russia's, 5 million barrels a day. Even if Iran is given a new lease of life, Venezuelan oil output is increased, all of this is going to take time to come on track, isn't it? And it's almost ironical that the country that has kicked off these oil sanctions against Russia doesn't really need it. It's 8% of what they import, 5% of what Russia exports, but everyone else, especially a country like India, is in a mess. Amit, your comment?
So, Tamanna, one of the things is, what is the problem we are trying to address? Is it just the price spike of the last few months or weeks, or is it the longer-term dependence India has on imported oil? So I would suggest two long-term options that India can have. We need to look at what some of the other countries do to balance their risk to energy prices. Example number one is Norway, oil-rich country. Excess money from oil exports was channeled into a sovereign wealth fund, and which you can also call it as a rainy day fund. Now, we in India had a 7-year window of low and moderate oil prices. Some of that money should have been diverted to create a similar rainy day fund, which invested in oil assets and oil companies in other stable countries. The financial returns from these would offset some of the blow that we are facing right now. Let us remember that this is not the last time oil prices, this is not the final price of oil. It will also fall at some point. Let us take this opportunity to make those investments when the price again moderates. We will import oil for the next 15, 20, 25 years. The second approach we would like to suggest is similar to what Mexico does. Mexico is again an oil exporter. they sell their oil in the futures market, in the forward market, because if oil falls below a certain level, it will hit their budget. Now we are on the other side of the trade. Can we again use financial markets to buy options when oil is at 50 and oil at 100 is unacceptable to us? Should we buy call options at $90, $100 a barrel in international markets, which are large and liquid and can tide us against these kind of disastrous outcomes? We should look at this as a form of insurance. We should be happy if that money goes to waste and is never needed. But the day it is needed, it is better to have it.
Mr. Chandra, I want to come to you on the issue of our reserves. Now, we have had a pretty decent, actually the world has had a pretty decent run on crude prices for the last few years, barring, of course, say the last 6 months to a year. Before that, we have seen a phase even when crude was around $60, etc. a barrel. Was that the time to build up reserves? Have we built up enough reserves? Give us some perspective here.
You see, the strategic reserves that we have would last us for about 12 to 15 days. Add to it the inventories which are maintained by refineries, and you get another 45 days of reserves. So you have about 60 days of reserves. Now, 15 days is too little. The government of India is expanding its strategic reserves, but that will take time. After building those reserves, you will have to fill it. That needs a lot of money also. Now, the question of futures market, forward market in oil, that has been considered by the government, and it's not been accepted. And there are good reasons for it. So, because I don't think any country really, a sovereign country or even an oil marketing company goes in for options and futures in crude oil. What they do hedge is their refining margin, which is what affects them. So that is one. In the short run, as I look at it, there will be pain, whichever way you look at it. In the medium run, we need to increase our domestic production. But let us not forget that crude oil has a global price.
Can you explain? No, just if I can just understand something from you, sir, Mr. Chandra, again follow up for you. Why do our reserves hold just 15 days? And why have we not increased it so far? I mean, it's not news to anyone that we're highly dependent on imported crude. It's not news or anything new that it's a highly volatile commodity as well. So what has entailed or what has stopped us from expanding our capacity for reserves?
Basically, financial resources. Building them, constructing them is capital intensive. Filling them again needs a lot of money.
Yes, sir. The questions for you, Mr. Chandra.
No, I'm answering that. You see, building a reserve needs a lot of money, and it comes from the budget. Filling them also needs a lot of money, which also comes from the budget. Now, we've had severe constraints on the budgetary resources. It's what Paul Samuelson would say, guns versus butter. What are you going for? So every government has its priorities, but nevertheless, Government of India is investing in expanding the strategic reserves. One of the reasons why we are not a member of the IEA is because IEA wants you to have 90 days reserves. The West has it. All members of IEA have it. But as I look at it, 5 million barrels which Russia exports per day, not all of it is going out of the market. I don't see Europe going along with Russia to ban oil exports from Russia. USA may have done it because its dependency is very low. It doesn't import any gas. So Europe is very dependent on Russian oil and gas. And there will be a problem. The model that Germany is following is, what does it say? You have renewable, and the intermittency is going to be overcome by gas-based power generation. What will happen is that the mothballing of the nuclear plants, the mothballing of the thermal plants is going to be postponed. So climate activists would again get agitated, but that's it. As far as the Indian consumer is concerned, we will have to end up by paying a higher price. How much is dependent on what the government decides.
Well, there is no free meal. Just quick comment from Mr. Taneja before we wrap. And you rightly said that oil and the politics of oil is something which is completely intertwined. Why just in the Indian context? The fact that Mr. Biden is also being very aggressive on sanctions against Russia and talking about the pain of crude is because he's already dealing with unhappiness because of high inflation in the United States. So it is all interlinked. But my question to you is, how much of the 16 to 20 rupees do you think should ideally be passed on and can ideally be passed on to the Indian consumer? Remember, we have inflation woes breathing down our neck. We have high food inflation prices and all of those issues. So is it a one-third split?
I don't know. It's going to be a very tough call for the government. Not an easy decision given the overall, global economic situation. Of course, Indian economic situation is going to be extremely, extremely tough. But that said, Tamanna, on Russia, because that's the central of the whole debate. We import roughly 2% requirement oil from Russia. Our dependence on Russia is very, very small. But we have made serious investments in Russia in the region of about $16 billion investments in oil and gas alone in 3 major fields, but we also have investments in small fields. Can we bring all that to India? I mean, look at the map carefully. It's not that easy. Western side, the war is going on. East is too far to ship that oil first there. And Arctic is most of the time is frozen. So we don't have too many options. But Russia is a big boy in the energy landscape. If Russian oil completely goes out of circulation, that's going to basically push the prices up. But look at President Biden's speech yesterday. No sanctions on India. If India wants to continue to deal with Russia, there are no sanctions. Germany has been exempted. Italy, Europe, for that matter, has been exempted. So now that means they are going about the whole thing in a very pragmatic way. At the same time, we issued a warning to speculators and all the oil producers that don't be greedy. We are watching you. So I think that's why the prices have come down. And my own sense is that, President Putin has said oil price may go up to $300 per barrel. I think it's all war rhetoric. I don't really take it seriously. My own sense is that, wait for some time. And if the war doesn't go completely out of control, NATO doesn't jump into it and all that, which is not unlikely to happen, then oil price stabilize with Ukraine premium in it. Right now, if you look at the price, cost of production, demand, supply, and everything, I mean, oil should not be more than $80 per barrel, but it's still at 120, which means there is this war premium at $40. So, but as he said, but all these countries are coming together. And I think once things start settling down internationally, you will see crude oil prices will start coming down and may stabilize in the region of $100, $110 per barrel. Because don't forget, in America also, they have elections for the Congress. And President Biden would not like to see oil prices so high that people vote Democratic Party out of Congress. And eventually then he loses elections in 2024. So it's a political commodity world over.
And therefore, President Biden they produce most of their own oil. Sure, it is a political commodity, but
they also import.
That's the thing.
No, but they import.
Biden's decision
they also import.
8%. 8% from Russia. 8% from Russia.
No. Globally, they import. They import from Saudi Arabia. They import from
So I'm saying
Iraq,
that's
So they also import.
Globally, they import. Yes. So that's the interesting thing. He's announced sanctions which right now don't affect his country too much, but definitely affect ours. It's going to be a tough call on how to make sure that that burden is split in a way which doesn't hurt the fiscal deficit beyond a point, doesn't crush OMCs, and of course, doesn't crush poor Indians. We'll have to take a very short break here, but I want to thank all of you for joining us on the lead debate today.